Lecture number 3 on basic terms in accounts. The next term very oftenly used in accounts is sales. The goods or services sold by a concern is called sales. When the purchased goods are sold in order to earn profit, it is called sales. Goods which are purchased by the businessman, when they are sold with a motive of earning profit, then it is known as sales. Sales may be cash sales, or it may be goods may be sold on credit. So cash sales and credit sales both makes total sales. The total sales includes cash sales and credit sales. Next is sales return or return inwards. So when the customer whom the goods are sold returns the goods back to the supplier, it is known as sales return. The goods returned by a customer to the organization or concern is known as sales return. The reason why the goods are returned by a customer may be that the goods are not according to the sample, or the goods are not according to the quality, or they are damaged, or they are oversupplied. So the customer may return the goods to the supplier, which is known as sales return. The total sales minus sales return gives us net sales. Total sales minus sales return gives us net sales. And what is total sales? Total sales is equal to cash sales plus credit sales. Next important term used in accountancy is stock. Stock are the goods which are left behind, which is left unsold in the business at the end of the year. The stock which is not sold and it remains unsold in the business at the end of the year is known as stock. The goods unsold at the end of the year, the goods unsold at the end of the year are called closing stock, and this same closing stock is called opening stock at the beginning of the new year. The closing stock at the end of the year is carried forward to the next year, and this closing stock becomes the opening stock at the beginning of the new year. Next important term used in accountancy is revenue. Revenue is the amount received by the business for selling goods or services. When a business performs its business activities of either selling goods or providing services, the return it gets in the form of money is known as revenue. This amount is received from day-to-day activities of the business. And this revenue may be in the form of rent or interest, commission, discount, etc. Next is the expenses. Just opposite of revenue is expenses. Expenses is the cost which the business incurs for producing goods and services. While producing goods and services, the cost which a business incur is known as expenses. This includes wages to the laborers, salaries to the office staff, freight, advertisement, rent paid, insurance, etc. In other words, we can say that expenses is the cost of earning revenue. The cost that we incur in order to earn revenue is known as expenses. It is usually of a small amount and it is incurred while day-to-day activities of the business. Next important term is expenditure. The amount which is paid for increasing the profit earning capacity of business is known as expenditure. Usually this the amount spent on acquiring assets, liabilities, or the amount which is spent for a long period of time, it is known as expenditure. It is spent usually on acquiring goods and services, often for a long period of time. So the nature of expenditure is of a long period. It is of long period nature. It is very important to differentiate between expenses and expenditure. Expenses are incurred for day-to-day expenses, while expenditure is incurred for acquiring assets, liabilities for a long period of time and for increasing the profit earning capacity of business. Expenditure is of three types. First one is capital expenditure. All those expenditures which are made for purchasing, acquiring, or for buying fixed assets or adding to their value is known as capital expenditure. The expenditure done on acquiring fixed assets or increasing the value of adding to the value of the fixed assets is known as capital expenditure. Examples are purchase of land, purchase of building, purchase of machinery, addition to machinery, purchase of furniture, etc. The next one is your revenue expenditure. Revenue expenditure is the expenditure which is incurred to carry on the normal course of business. That means it is required for the daily running of the business. The money the expenditure done on day-to-day basis is known as the revenue expenditure. The benefit of this type of expenditure is exhausted within a very short period of time or within an accounting period. Examples are purchase of goods, purchase of services, payment of wages, salary, etc. Third one is deferred revenue expenditure. Deferred revenue expenditure. This type of expenditure is a revenue expenditure whose usefulness extends over more than one accounting period. Means this type of expenditure is done once, but the benefits of such expenditure spreads over a number of years, or the benefits are also for the future. Examples are large amount spent on advertisement done once, advertisement campaign done once in a year may benefit for a number of years. Then discount on issue of debentures issued once will give benefit for a number of years. So expenditure done once, but its benefit is spread over a number of years.